What if I told you that one of the world's biggest names in cookware, small appliances, and everyday kitchen tech is trading at a big discount, and barely anyone's talking about it? That's the kind of opportunity we track at Insightful Value. Today we're diving into Groupe SEB, whose stock has been sliding, but under the surface there's more than meets the eye. This review is for informational and educational purposes only. It is not financial advice. If you appreciate deep dives into undervalued companies, give this video a like and subscribe for more. Let's start with what Groupe SEB actually does. You might not know the company by name, but chances are you've used one of their products. Think Tefal, Rowenta, Krups, Moulinex, WMF, and more. This French company operates in over 150 countries and sells small household appliances, cookware, and professional equipment. In other words, they're a global leader in products we all use, just not in a flashy way. So why is the stock down? Groupe SEB has been dealing with a perfect storm of pressures: rising raw material costs, weaker consumer spending in Europe and China, and currency headwinds. Revenues for the first half of 2025 were down slightly and margins were squeezed as the company tried to avoid passing cost increases fully onto consumers. Operating margin has slipped under 6% recently, compared to around 8 to 9% pre-pandemic. Net income is also under pressure, but it's not all bad news. The company remains cash flow positive, continues to invest in innovation and sustainability, and is actively managing costs. Their consumer segment is facing short-term pain, but the professional division, which serves the hospitality industry, is holding up better. Groupe SEB is betting on a rebound in demand and supply chain normalization to restore margins over time. From a value perspective, the stock is trading at a historically low multiple relative to earnings and book value. The dividend yield is hovering around 3%, and while the payout has stayed flat in recent years, it's been consistent. The company has a long record of returning cash to shareholders while maintaining a healthy balance sheet. Debt is manageable, and interest coverage remains comfortable, even in a high-rate environment. So why would someone consider Groupe SEB right now? You're getting exposure to a portfolio of brands with strong market positions, solid manufacturing capabilities, and global reach at a valuation that reflects a lot of pessimism. If consumer sentiment improves or input costs drop, Groupe SEB's earnings could rebound faster than expected. Why not consider it? There are structural headwinds in Europe, competition from low-cost players, and a risk that consumers continue to tighten spending. Recovery might take time and require patience. Is the stock going to bounce back soon? That depends on how fast inflation moderates and if discretionary spending stabilizes. But with a strong brand portfolio and decades of operational experience, Groupe SEB could surprise on the upside when the cycle turns. At Insightful Value, we focus on deep research into overlooked companies like this. We cut through the noise and explain what really matters in clear, actionable language. If you're interested in finding more opportunities like Groupe SEB, check out our website at insightfulvalue.com. And don't forget to subscribe to this channel and hit the like button if you found this helpful.